Good morning. This is Arlan Suderman, Chief Commodities Economist at StoneX, and I want to give you an update on the developments to start the week with the tariff battles going on, and with the Trump tariff war, and what's been happening. Kind of update. First of all, we got reports over the weekend that 50 countries or plus had requested or reached out to the White House to request negotiations. Some of them even say we'd like to negotiate tariffs down to zero. Keep in mind that that was the original objective, as stated to us, that the reciprocal tariffs were for the purpose of bringing countries to the negotiating table. That list of countries that we know of or that we have heard reports of includes some countries with some of the strongest tariffs applied to them. And so, if in fact this would play out, if in fact President Trump is successful in doing this, then you could see tariffs come down globally, and that would spur economic growth and create an economic boom, so to speak. Now, we're a long ways from that, and things could certainly fall apart ahead of that. So we need to respect that possibility. But this morning, I want to focus on, first of all, as we start off, on the VIX. As we look at the VIX, which is Wall Street's fear index, it traded as high, just probed above 60 overnight. Now, if you look at its history over the last several decades, it rarely goes above 50. It's sustained moves above 50 roughly three times. Once during the Great Recession in late 2008, which carried into early 2009, when it spiked to nearly 90. Didn't actually hit it. It was a little below that. The next time was during the pandemic when fear gripped the markets. And then briefly, the 1st of August of last year, roughly, when we had the yen carry trade unwinds that created a lot of turmoil into the markets. Now, it's been my observation over the past several decades that whenever the VIX trades above 30, it's difficult for any commodity to sustain a rally unless that asset has a strong story of its own. Now, I would argue that we don't really have any assets right now that have a strong story of their own. Perhaps a couple of them have already traded it. For example, we've seen cocoa trade their strong story. We've seen coffee trade their long story. Doesn't mean that it's over, but I'm saying it's not new news, so to speak, and they've already elevated to considerable levels. But it makes it difficult to sustain a rally because the fear level is so high, and so a lot of the money flow is simply flowing to the sideline or to the safe haven assets. And so as we find ourselves this morning as we talk with the VIX trading right around that 50 level, having traded above 60 overnight, that's something we need to keep in mind. We need to watch for that VIX to start working its way lower. And for that, we need to see more stability in the equity markets. And we saw a sell-off overnight, and then we saw some calming of the waters with when we came in this morning to open up the trade desk. We were near session highs, although still lower on the night in those markets. And then when we opened officially the day trade in the United States, we did some additional selling again. But to me, and this is what I commented to our people on Sunday afternoon, I want to see how we close on Monday. The overnight happened just as I expected. Now, how will we close today? And I think that'll tell us something about whether we're going to try to carve out at least a short-term low now this week or in the near term. Now, let's talk a little bit more about the commodities specifically. We service producers of commodities. We service consumers of the commodities. And of course, we have our institutional customers. If you're a producer of commodities, we need to recognize that the risk is ongoing. It continues to be with us. Just remember crude oil trading negative a few years ago. The algorithms are responsible for much of the trade, and they tend to amplify the moves. When momentum is to the upside, they're adding on buy orders. When momentum is to the downside, they're adding on sell orders. And so that tends to magnify, amplify the move, so to speak, and they will go until something turns them around. And so we need to respect that. If you're a producer of a commodity and you have to worry about that downside price risk. If you're a consumer of the commodity, and we met with a bunch of consumers at a conference in Panama at the end of this last week as this was all unfolding. You have to look for opportunities, and where at what point does your upside risk become greater than your downside risk? And of course, the lower prices go, the greater your upside rebound risk. Yes, they could go lower, but focus on those margins. When do the prices give you opportunities to lock into margins, knowing that in this type of volatility, you can get very rapid recoveries as well. And so the lower prices go, the more you need to consider that. Now, I'm going to pull out an example here, and that's crude oil. As we saw crude oil trading from over $72 midweek last week to below $60 here this morning. WTI crude oil, in fact, traded as low as $58.95. So that's somewhere around a $14 decline in a few trading sessions. We estimate that the break-even production costs in the Permian Basin are around $62 a barrel. So now we're taking prices down to a level that we can start seeing production shut down. And so that would be expected to provide support. Again, what I said earlier about downside risk is you always have to respect that. If I were president, and I'm not, thankfully, this would be a great opportunity to start buying oil for the Strategic Petroleum Reserve. Now, President Trump believes that we should have $50 crude oil. I don't think that's realistic in today's world when the cost of production is $62 per barrel, but we need to respect the fact that Saudi Arabia and OPEC apparently respected President Trump's request to increase production because they have tripled their output increase that they had scheduled for starting next month. And so over 400,000 barrel a day increase now is what they announced at the end of last week. So that, yes, that does mean lower crude oil prices, but right now we also are factoring in recession fears of a global recession that's going to slash demand for energy. You have to respect, if you're a consumer of that energy, what if it's true that we have these countries all wanting to negotiate lower tariffs and we actually spur economic growth? And so we have to respect that possibility as well. I'll point out another commodity, it's corn. Amid all the headwinds last week, the corn market refused to go down. Fund managers saying we've liquidated a lot of our longs, but we're not comfortable going short. Why? Because fundamentally we're seeing a building story. Global supplies among the major exporters are rather snug. Right now, the U.S. is the primary supplier to the world. We're seeing very strong basis prices in Brazil ahead of their safrinha crop, their major crop, their 3/4 of their production heads into pollination. They had some timely rains over the last week to 10 days, but now the forecast is turning much drier going forward, and 50% of their crop will pollinate during the last half of April, with the rest of it pollinating shortly thereafter. Very compressed this year because the production, the planting was delayed and then went in very fast. So all pollinating in a very narrow window, putting a lot of risk on it. When forecasters say stress is going to be increasing over roughly 40 to 50% of the growing belt. And then we're seeing repeated climatologist after climatologist raise the red flags of warning about the U.S. crop this summer, calling for hot and dry conditions west of the Mississippi River. Don't know if that's going to happen, but we're certainly seeing a lot of forecasters who are raising that red flag. And fund managers are taking notice of that. Over the weekend, we saw the news reports of the flooding in the southern Midwest, Ohio River Valley, etc. That's the heart of the soft red winter wheat belt. Soft red winter wheat does not like wet feet. That tends to lead to a lot of disease problems. And so we're seeing a rapid recovery. And when wheat prices are this cheap, we're seeing a lot of short covering come in this morning and leading the way. Because remember, even though we got some timely rains over the weekend in the hard red wheat belt, it still missed some critical production areas in parts of Texas and in Kansas. And the forecast has gone dry again, and we're entering that critical reproductive phase. And we're also facing dryness in Russia's winter wheat belt as well. So wheat and corn and strength. Soybeans are more or less getting that bounce. I think the sell-off last week was overplayed. China had already left. I do expect, we look at less than 600,000 metric tons of soybeans left on the books from China, even taken shipment. We believe virtually all of those are Sino-grain, so they can pay themselves the tariff. The bigger threat to them is the port fee, so they've been taking shipment. Wouldn't be surprised at all if they cancel a few of those cargoes just to send a message. But as we talk about China, I believe this will bring them to the negotiating table much quicker than it did during Trump 1.0. Their economy is struggling. Even with the stimulus that they've announced since September, their economy is struggling. It has been propped up in some areas where the stimulus is. They've increased their debt, but they're increasing their debt to the point where Fitch on Thursday, and this was largely overlooked, Fitch lowered their credit rating because of how bad their economy is struggling and their debt is rapidly piling up. And our sources are telling us that this Trump tariff package is more than what China can stimulate their way out of. It's going to be too burdensome for them to do so. And by matching the tariffs, they may have hurt beef demand, but the biggest thing there is the delay in approving the credentials for export facilities for beef. It may hurt pork demand. Remember, our beef is a high-end product in high-end restaurants in China. So consumers may, and that's a may, we're still waiting to see, be willing to pay it. The bigger problem right now is approval of the export facilities. May hurt our pork. I do think that that's a real risk there. Soybeans, they'd already shut off basically until our new crop supplies, and with the big South American crop, that's going to be even later this year than what it normally is. So we have some time to bring them to the negotiating table. They had basically cut off purchases of corn about a year ago. Grain sorghum 6 to 8 months ago they cut it off. Wheat, same thing. And cotton is at risk as well here from China. But I do expect them to the negotiating table, even though they have given tough language. They raised the tariffs to 34%. That probably didn't do a whole lot more in the grain and oilseeds than what the 10% already did, because as long as they have supplies in South America, because the currency exchange rate says they're going to be cheaper anyway. So fear is a powerful factor. We need to respect that. But look to see if we get some bottoming action this week in the outside markets. And if we can get that VIX down below 30, that would be a big boost. And look at what we're doing with the grain and oil seeds this morning already, with the VIX trading as high as 50. I think we need to take note of that in the commodities. And then crude oil being at a position that it is of below the cost of production in the Permian Basin, and an attractive buy for a strategic petroleum reserve. So this is Arlan Suderman once again, wishing you well as you manage this risk, and we'll try to be back with you to keep you updated on the latest developments as we go through this week.